Howdy, Jacob here. Today we're looking at ASGN Incorporated in the professional services industry. 4.6 billion market cap, about 5.5 billion enterprise value. They engage in the provision of IT services and solutions in technology, digital, and creative fields for commercial and government sectors in the North America region. Growth has been was very impressive at the end of the 2010s and just recently dropped a little bit. But for a CAGR perspective, you're looking at about 11% year over year CAGR over the last 10 years. Very impressive. Return on invested capital, maybe 7-8%. Nothing to brag home about. Earnings per share, good growth. Operating margin and gross margin, pretty consistent. Gross margin is actually down a little bit from 32% to 29%, but operating margin is actually up a tiny bit. So they are getting more efficient to that bottom line by a tad. I mean, 8%, 8.2%, relatively flat, but 176 million cash on hand, no short-term debt, $1 billion long-term debt. Looks like they made an acquisition from 2017 to 2018. We see 575 million to 1.1 billion, and then on goodwill, 900 million to 1.4 billion. So let's see what that is. Okay, 760 net acquisition. Issued debt for it. So that's going to be likely coming due soon unless they refinance that over here. Use of cash recently, very heavy on share repurchases. Very heavy. Otherwise, they make some acquisitions, pay down a little debt. Doesn't look like they really reinvest back into themselves or pay a dividend. So not bad, but just pointing that out. So I think we're ready to make some assumptions. I think I'd probably be comfortable with maybe 5% revenue growth. And then just because they have that little bit of net debt, I'll probably feel comfortable with that 13 PE. Margins, I do like that. Free cash flow is pretty consistently higher. Let's do a little bit of a range there. So 1% would be about 46 million. They do a lot more than that. So 90 million, 180 to offset about 220. I mean, we're looking at 4%, and that would be paying out, let's see, 46, 90, 180, 220, $220 million. I mean, it's a lot of their free cash flow, but it's really what they've been doing the last couple of years is 75+% of that free cash flow is going towards share purchases. And so I feel pretty good about that. And that still gets the price to almost need to fall in half before you get the 15% we're looking for here. I do think pretty solid company. And I think, there's always growth in the professional services industry, but we'll see what the business actually does. And for me personally, I'm just going to wait until it falls a bit closer to do some more research on it. But again, hope you enjoy the video. Have a great rest of your day. Thank you.